So we're good, right? So who in this room has traded options with me on Friday? Has anybody traded options with me on Friday in the room? Not just me in the room. Daryl has, yes. Hand is up in the air. Okay, who has not traded options with me on a Friday in the room? Okay. So, to begin with, I trading options on a Friday is a unique experience. And I live for between 12:30 and 4 o'clock on a Friday for my trades. I find it is the best time to be trading options, assuming that you have a market that is actually making some type of move. It doesn't have to be a big move, but it's making a move. Now, what do I mean by that? If the SPY gaps up and just moves sideways the whole day, and every stock is just moving sideways, it's very disappointing. Okay? Now, who has seen the emails that I sent out about the wins we had on Friday? Who has seen those? Has anybody? So let me show you a couple here. Okay, and I'm not doing this to brag, okay? Because there are Fridays that we have when we have really, really, really hard days, right? Let me show you something here, guys. This is the Apple 121 puts last Friday. See this? Once again, you're going to get better video if you log into the Join Me. There's only 17 out of 33. See how this $11 area here? Do you guys see that? These options were on the 120. Actually, these, I apologize. This is the 120 puts. Okay? These options, 10 cents up to 50. 10 cents up to 50. See that, guys? What's the percentage on that? That's the Apple 120s. Here's the Apple 121s. 40 cents to $1.10, 50 cents to $1.44. Here's the Amazon. This is the Amazon 630 puts. $1.50 spiked up to $3.70. Okay? This is the Facebook 102 calls. Reason I'm showing that is we caught it. Facebook on a bounce. Facebook bounced down to $1.02 area, right? And said, let's go long Facebook. It was like 50 cents. Bounced up to $1.30 in about 20 minutes, 30 minutes. Okay? This probably was the one where those of you that were trading made your money. The SPY 209.50s. Who took that trade? I'm pretty sure Charles did. I know if you caught this. Bottomed out around 30 cents. I remember saying try to get it at 36. As close to 36 as you could get it. Remember that, Charles? I'm like, guys, try to get as close to 36 as you can get it. Didn't want to pull back. Hit this area here. Just said go in. Just go in and get it. So it went from like 26 cents up to $1.70 in after hours. And yes, you can trade after hours on a Friday or any other day, 4:15 on the indexes, right? Okay. So what do you notice about everything here is that they move fast and they move quick. Okay, and I know Daryl had this one. I know for a fact that Daryl had this one right here. He had those 120s. He had them here. I think you might have had him. No, you had him here. Pull back. He got out too soon. He got out like here, and then just shot right up. You booked him in after hours, Charles. Charles held those SPY puts, so he probably got him for like, I think you got him at 44 cents, right? And they went to like $1.70 in after hours, something like that. So let's ask ourselves real quick. Okay, let me answer a question here. And this is the webinars here are a little different than you're gonna see in it. I don't come with slides. I'm gonna do a slide presentation on this, like a little workbook. Excuse me. But I like to do it more interactive. I'm gonna do a little workbook together, put my thoughts together, and do a little workbook. Okay, there's a couple questions. Danny, guys, so let me go over some ground rules for everybody that's trading options on Friday. Marcus, to answer your question, you can trade the indices until 4:15. SPY, QQQ, I think even like UVXY, I'm not sure. I'd have to check on that, Charles. I think even like UVXY, you can trade until 4:15. So let me go over some ground rules about day trading options on Friday. And I'm mainly looking at day trading. However, some of these are going to apply to trades that you may want to put on Thursday night in swing trade. Number one, if you are going to be doing these trades, you are going to need a broker that offers you a good price per contract. Okay? Because think about one thing. You got Apple, let's say you get it at 15 cents and you get out at 40. If you're paying $10 round trip and you go in one contract, it's going to cost you $20 plus whatever your contract fee is. You're going to give away most of your gains in commissions, okay? You can't do that. You need, anybody that has toss can get a 150 a contract rate. Anybody that has interactive brokers, you're under $1 per contract. If you're paying $10 each way, plus $1.25, it's not going to work for you. Why is toss killing you right now, Scott? You can get $1.50 a contract or less. $1.50 a contract or less, you can get it. No, but you can get it. Sometimes they'll give you even less, maybe $1.25. Okay, let me pause the recording a little bit here for a minute. So number one is you have to get your contract fees to a reasonable level. Number two is you have to call your broker. Pick up your telephone, call your broker, ask them how they deal with contracts that you want to day trade on the same day if you don't have the money to cover an expiration. For example, TradeStation is going to close out your positions automatically starting at 3 o'clock. And if they close it out, they're going to charge you $50. Toss, Toss is free, Jazzwander. Toss, if you don't have the money, they're going to start closing them out. They don't charge you, but they'll close it out. However, you can call Toss at the night before and say, hey, I'm going to be day trading some options that expire same day. Kind of leave me alone. And you know what? They're going to kind of leave you alone. With TradeStation, talk to your rep. They'll give you until 15 minutes before they expire. on TradeStation. Yeah, TradeStation does. But if they don't and you don't do it, they're gonna start closing your positions out at 3 o'clock and charge you $50 every time they do. But if you call them, they'll let you keep it until 15 minutes before it stops trading, which means you can't trade the last 15 minutes. And through the SPY, they'll let you trade it right up till 4 o'clock. Now, the reason the brokers are doing this is they don't want you to get assigned something that's in the money that you don't have the money to cover, and then they got to take on the risk. Okay, Interactive Brokers is a lot different than most of them, a lot more flexible. Excuse me. Number 3, you have to be able to day trade. Okay? And unlike what many people are going to tell you, you can day trade options without $25,000 in your account. And the way you can do that is if you have an account that is just no margin, it's cash. No, Jaswinder, you don't use TOS to trade with Interactive Brokers at all. Most people that have TOS with Interactive Brokers, they use TOS to do the charting. Okay, so you need to be able to day trade. Who here cannot day trade for whatever reason? Actually, so think about this. If you want to day trade options, you can have a cash account with no margin. You can make as many round trips on settled funds as you want. Options clear the very next day, assuming it is not a bank holiday. So if the bank is open tomorrow, all your cash will be available on any of your positions that you close today. Okay? So many of those that I've mentored before, not on options, Danny. Options settled the very next day. They told you wrong. That is on stocks. Stocks is T+3. Options the very next day as long as the bank is open. Okay? Some people that I know that want to do their spreads and have the ability to do spreads and they want to day trade options, they may have like 10K in their spread account and they may put a couple K, 3K in just a directional account where all they're doing is directional trades, cash, no margin, they can day trade. Okay, does that make sense, guys? Do not be coming in on a Friday if you got a margin account and you're looking at making trades and you're counting down the clock on how many day trades you got left. It's not going to work. You're going to get in a trade and mentally you're going to say, I only got this amount of trades. I might as well stick this out. No, it's not going to work. Don't do it. Don't be held hostage ever to your the limitations like that. Work around them. Okay? So, with that said, we got that out of the way. So why do we trade stock? Why do we trade? Let's think about one thing, right? Why, as options traders, why do we trade options versus stocks? The reason I trade options versus stocks is very simple. I like to risk a predefined amount of capital per trade. Okay? So think about a stock trader. He may enter 1,000 shares at $20, right? So he's got 20K in that, okay, right? He makes 20 cents on the shares, right? Oh, sorry, 1,000 shares times 20. He makes $200. So he's put he's put $20,000 of capital outlay to sit here and make 200 bucks. Battling the spreads, the slippage, the emotions that go in your mind of having $20,000 of your capital in a trade that can go against you. Now, look at the SPY put. You could have gone in on the SPY, and I think Moto got it around 40 cents. You could have bought 10 contracts. Okay? At 40 cents. The most you can lose is $400. And it went to 170. Okay? No, we're not talking. No, this was last Friday, Moto. I'm talking last Friday. Oh, you did the 44. I think you got 44 cents, right? Yeah, I got it at 44. He got out way too early. He blew it. He admits it. But it ran to 170. Right? And he was even fighting a little bit for a better fill. And I told Moto, don't fight for a fill. Just get in it. Just get in it. Okay? The point I'm trying to make though, guys, right? If you had done 10 contracts with options, you could have taken that $400 and turned it into. It actually went to 170. It closed at 170, but we'll call it 160. $1,600. Okay. Right. You guys see that? Now look at this stock trader. And let me tell you a little secret here, guys. And this is what I like to trade. This is why I like to trade on Friday, the options. What happens to the option pricing on Friday versus Monday? What happens to those prices? Cheap. Why are they cheap? Okay, so what is in an option price? Time, real value, and implied volatility. Okay? We're not going to focus so much on the implied volatility. Okay? Yeah, Moto made 47% return in about 10 minutes. We're not going to talk about implied volatility because we're going to make an assumption the applied volatility on a Friday is not going to change the price of the option that much. The time and real value, many times we're going to be trading out of the money, and the time value, as you have said, are really cheap. Right, Charles? 6 trades in 1 hour just set up. And I don't know how many of you guys took them, but they just set up. The point I'm trying to make is, let's look at our options chain right now, and let's look at what makes option trading on Friday even better for us options traders, and how we have what I consider a real advantage over a stock trader. Okay? We have what I consider a real advantage over a stock trader. And I guess I'm going to have to detach this. Okay, so here is, it's a Wednesday night, okay, and it's a Wednesday night, and I'm going to show you an at-the-money Amazon put on a Wednesday night. How much is it? An at-the-money Amazon put on a Wednesday night. How much does it cost? Well, actually, in the money. Do it in the money. 540 by 630. Yeah, like probably like $6. Okay. Let's go back to our Amazon trade on Friday. This was an in the money put. How much was it? $1.50. You guys can still use. Please use. Join me. It's gonna be faster. There's only 22 and join me. Someone got the. Okay. $1.50. So as options traders, we can trade an in-the-money Amazon put on a Friday cheaper than we can on a Monday, Tuesday, Wednesday, Thursday, Friday. That same put that you're looking at right here is going to drop to about $1.50 on Friday. And here's the deal. It's going to move twice as fast. 3 times as fast. It's going to be cheaper and it's going to move faster. Does this all make sense? Now, with this, with what I am explaining to you that's happening is there comes a risk. Where did I get the 150? That's what it was. Eduardo. Last Friday I was trading an in the money. I was showing the chart for an in the money Amazon put. And the lower day was $1.50. I was looking at it when it was 164. And it's the same one that's trading right now and in the money for 3 times as much. Yes. So what happens that makes these options move fast? The time, there's no time left in them. Your premium on these options are very, very low. And as Marcus says, you get a gamma explosion on those. Okay, if I look at an option right now, and I want to go back to this chart right here. Okay, and I want to look at delta, gamma, theta. Okay. See your gamma on these options? It's nothing right now, right? Friday, your gamma is going to be as big as your delta at a certain time. Which means if the option moves $1, the next move it makes is going to be 2 times the amount it made on the first dollar. Give or take. You get a higher delta and a higher gamma. And your gamma your delta as the day goes on gets stronger and stronger and stronger until when we are trading around 3 o'clock, anything in the money is almost a 1 delta, maybe 0.88. Does this make sense? It's like, yeah, it really is. It's close to 1. Anything in the money around 2 o'clock, 2:30 is close to a 1. That means for every dollar move, your option is going to go up $100. You're getting almost a 1-to-1 with that stock. And unlike the poor day trader that wants to make $200, he's got to maybe put 20K on the line. For you to make $200, Moto bought those buy puts at 44 cents. All you had to do was put up $200. However, with all of this and what I'm telling you, doesn't it sound exciting? Like just so easy to make money? Doesn't it sound that way? Moto did 10 contracts. He made like 200. He put 440 at risk, and he made 210 profit in minutes. 10 minutes, Moto. You know, I said to Moto, don't look at the option, right? Don't look what it went to. You know, Moto said, I don't care. I made $200. It wasn't right. It wasn't 440 at risk. You obviously you have a stock, but just assuming, right? You're not going to, but you have to assume the worst can happen. Your trading platform can freeze, but it's not going to. He is right. That's not going to be 440 at risk. There is a downfall here, though, guys. The downfall is they move fast. When they move in your direction, it's amazing. right? So he's, and I'm gonna make a rule of thumb that on a Friday, when you're day trading options, you're gonna have to accept about a 50%. Is that about right, Moto? About a 50% risk. If it really moves against you fast, you gotta give it a little wiggle room here. You gotta say, okay, right. So what you have to do when we are accepting and expecting a 50% max loss, no, it won't. Not at all. You're gonna lose it on the. Moto's saying the 5 to 10% won't get the job done. It won't. Okay. How do you as a trader deal with that, guys? Tell me, how are you going to deal with that as a trader that you got to give a 50% loss on it? How are you going to deal with it? Somebody tell me. You're going to trade what you have no emotional attachment to. You're going to adjust your position sizing. And the first time you do it, like I said, if you got $1.50 contract with Think or Swim, or if you got dollars with interactive brokers, go in one contract until you understand it. You never double down as Marcus. You don't do it. You're going in, you're going out. Okay? And so you can deal with a 50% loss. You have to adjust your position size to fit your risk. Double down is averaging down. So if you put 200 in, it goes to 50. You put another 400 in, hope the thing works. That doesn't work on Fridays. Yeah, it does not work on Fridays. You don't do it. Accept your loss. This is why I'm telling you, I don't recommend, if you can only do 3-day trades, and let's say you only got 2 left, that you come in here on a Friday and try to do it. Because you're going to want to win, and you're going to think, I want to win on this. I'm going to win on it. You might just keep holding it till it expires worthless. It doesn't work. Now, Gary mentioned he uses limit orders. Sometimes, guys, if you see something move, you just got to go and mark it. That's how I do it. And it really depends. Okay? If you see the SPY moving and it's dropping and you don't get filled on your limit and you want it, as I told Moto last Friday, you just got to do it. So, let's look at what we try to do on a Friday. And guys, this is really simple. The first thing you want to do when you trade options on a Friday is you want to look at the options chain of the stocks that you trade. Excuse me. You want to look at the volume at your strikes, and you want to look at the open interest. You don't want to be trying to trade something with extremely low OI and extremely low volume as a rule of thumb. I like to look for something that has at least 500 OI, even more. The night before I trade, I'm going to look where all the volume's trading. All the volume trading today has been on the call side on Amazon. Not many were buying the calls, except at the beginning, 6:30. So I'm looking at tomorrow. I told someone in this room tomorrow, being a Thursday, I'm looking at Amazon out of the money puts. Now that's just me, because if it drops, those are going to go fast. So you got to look at the stocks you trade. Guys, someone give me a stock you like. Let me look at. Actually, Fit has good open interest. Someone give me a stock. No. I mean, give me like an oddball stock. Oddball stock. Not something a lot of volume. Okay, TGT. See, TGTs would be a hard, for me, would be borderline if I would be interested in trading this, just based on the open interest. And you got 500, you kind of got it. I would like to see more. It doesn't meet my profile of what I like. NTES, you only got open interest at 145 and 140. This doesn't look like it's going to be a good candidate. Let me give you an example here. Okay. Gary gave me a nice trade on liquid lumber traders. All of these options, there's no volume. You're gonna have a really hard time on something like this, day trading it, when you're getting spreads because of lack of volume and open interest. Does this make sense? BBRY is going to be one you can do. But I'm going to explain one thing on BBRY. Okay. So you want to find something that has liquid options. You don't want to be messing around with 50-cent spreads because the open interest is only 50. It's only traded 20 options. So look for above 500 on the open interest and look for liquidity. Now you got a game plan. Okay. Here is how I trade on Friday. I use two trades I make. Well, I make 3 trades. Okay, the first is the open range trades. And this is what I do every day of the week when I trade. If you're trading the open, it really has nothing to do with trading on Friday, except once again, the options move fast, so you can make a lot of money really fast if you're right. So what do I mean by an open range trade? I want to find one. So what do we mean by an open range trade? Okay, so let's take a look. Let's do IWM, right? IWM came up, it made this candle as the first candle. You see this candle right here? See that first 5-minute candle? Then it came up here, went up a little bit, right here, at 118.61. It broke that opening range, okay? It went from 118.61 and made a low. So it moved 61 cents. On a Friday, that is probably really close to a double right out of the gate, based on the pricing of the options. Right out of the gate, that's very close to go. Well, it broke here on the second 5-minute candle. 1, 2, 3, 4, less than 20 minutes. It moved 60 cents. And then I'm going to do a webinar on trading the opening range. This is one way I like to trade the open. I know a couple people that trade it in different chat rooms they run, and I feel how they trade it is just luck. I use a 5-minute, Danny, because I want to capture this move fast. I want to pivot. Here's my pivot. 118.62. The top of that range is 118.83. It's 20 cents, and I know I'm wrong. Okay? Does that make sense? I got a 20-cent opening range. If I go short here and it goes back up here, I'm wrong and I'm out. Okay? Conversely, I just caught a 60-cent move. Many people use the first 3-minute candles, first 15-minute. I like to snap and try to get in it right at the open. We've had some amazing trades for some of the traders in this room. Now, here's the thing. You don't have to use my system to trade the open. Someone asked, how would that look on the cloud? Well, that's a good question. How would that look on the cloud? And we're going to see how that would look on the cloud. Now, if you're an Ichimoku trader, I tend to do my opening trades not so much off Ichimoku, but you could have done. See, off Ichimoku, it didn't really give you a signal. Scott, it didn't give you that signal, right? It gave you. These are 10-minute candles. Let me use a 5. Use 5 on Ichi. See, it gave you this. You got the break. It didn't give you that signal. Now, you caught this up. You could have caught the break. It didn't give you the signal. Yeah, it is for me, Daryl. I use them a 10-minute. My Ichi trades I try to make into possible swing trades. I've had some 10-minute breaks of the cloud, like right here. You know, it broke the cloud here yesterday, or 2 days ago. It broke the cloud at 116.07. It never looked back, right? So if you had traded this break here, now if this happens on a Friday, guys, tomorrow, you're talking multi-baggers here, 500%. 116 to 118 on the IWM. If you catch that move on a Friday, you've got a 3, 4, 500% win. Okay. Open range trades. That's just how I trade the open. You know, you may have a different way. You may do Bollinger Bands or breaks, whatever. And then we go into the night before, and this is what we're going to do tomorrow night. We're going to look at open interest to get a bias. Okay, so think about, and I'll go over this a little bit more tomorrow, okay? So let's think about our options chain. Once again, I'm going to do a quick explanation. Moto, you might want to help me on this one, on this explanation. So let's look at this option chain for a minute and assume tomorrow these options expire. Can anybody in this room tell me, let's do IWM, I like IWM. Can anybody in this room immediately see anything on this IWM options chain where you would say IWM is going to stay above on Friday? Daryl, this is for you. Daryl B. IWM has 28,000 puts. Yeah, those two levels. No. IWM has 28,000 puts at $115. Okay? It's getting put heavy here. IWM, I can tell you, is most likely going to stay above 115 by Friday. Okay? As this chart looks right now, where do you think it's going to stay below? This 119 area, look at this 119 area. What do you see in the 119 area? What do you see in the 119 area? You start seeing calls. Heavy call at 119. Okay? So we look right now, where is IWM trading at? IWM is trading at 118.31. Where did it go to today? IWM went up, tagged the previous day's high at 119.03. So assuming tomorrow was Friday, my bias looking at the open interest, I don't want to call it a bias, it makes sense for big money to keep IWM under 119. Do you guys all understand why? Yes or no? If you don't, say it, please. Okay, so what happens is big money has sold the 119 calls. They sold the 119.50 calls. They sold the 120 calls. They collected the premium. Wendell, Eduardo, have you ever written a covered call? No? Yes, right? So if you've got a covered call, you own the stock and you write a call against it and you collect money. But you understand how it works? Yes or no? Yes. Okay. So if you understand how it works, think about it. You want to collect the premium, right? Right? You want to collect the premium. What if you write it naked? What if you write it naked without owning stock and it goes into your strike? Yes. So it's in big money's interest for them to collect the premium and keep the price below. Does that make sense, everybody? And what you're going to see many times is you may see big money come in and buy 10,000 shares and sell the say the calls against it. Now during the day, if that trade starts going against them, you may see big money start dumping the shares right out in the market. Boom, 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 boom. They just dump the shares. So what we have going into Friday trading is we can look where big money has big money invested. And I can tell you right now, this 119 call side, if I was going into a Friday, I would have this marked down as a very high place of interest for me. Yeah, sure. I will. Let's do it right now. So I can tell you if this was Friday, if this was Thursday night, and we're going into Friday. I don't know why this one's coming up. Okay. Tell you right now, at 2010, at 210, you got a 62K on the put side. Okay. That's the one that's going to alarm me the most, and the volume was 77,000. This is an area of interest on the SPY. And this may be one reason they're keeping this thing up. You got to go into tomorrow. Now, we got some news. Okay, so but keep in mind, guys, I'm playing a hypothetical scenario that this is a Thursday night. We're going into a Friday. I don't really want to talk about it because the open interest is going to change between now and Friday. So if this was a Thursday and I'm going into Friday, you got to respect this 61,000 put, in the 12,000, in the 34. Conversely, the call side is not that huge of a difference, except for the volume on the put side has exceeded the open interest on each one of these. So we got to see if it changes a little bit. I mean, my bias going into tomorrow on the SPY is going to be above two. They're going to try to defend 210, but there's 2 days left, right? So it's not a Friday. David, it doesn't work when you look at a true pin. It doesn't work as much as it used to. And when people say max pain, I like to use it as a bias and to see where price is near it on a Friday. Does this make sense? So here's the deal: if you go in and you say, okay, the pin on the SPY is 208.50, the SPY's trading at 210.50, it's probably not gonna work. But however, if this is going into a Friday and you're looking at on IWM, you're looking at this 119.50, this area right here. When you see it approach one of those levels, and it looks like a reversal, so let's say you come in and you see IWM approaching 120, and then you're starting to get a reversal candle right at 120. Well, golly gee whiz, you kind of look at it and say, okay, I think they're going to bring it below 120 to wipe out that OI. You got something in your favor. We're not talking that we're looking for a true pin. Does this make sense? Yes or no? I have in the back of my head that IWM is heavy on the call OI up to 120. If I see IWM rally to 120 and it looks like it's going to fail, then I'll say to myself, big money's doing their job and they're defending their position. I'm willing to take that trade if the technicals align with what I'm seeing. So if the technicals show a reversal candle at 120, and I know there's high open interest at 120 on the call side, my bias is big money's going to step in, they're going to defend their position, and I'm going to try to be a sniper and be in and out of that trade. Okay? Last Friday, and this was not a pin, okay? Last Friday, I'm going to go over that in a little bit. I like to trade on Fridays in the money, but I'm going to go over that in my next step. Okay? Last Friday we noticed high OI at 209.50 on the call side. I think that was right, Moto, right? I don't know if that was a pin, the max pain, quote unquote. I have no idea if that was a max pain, because I don't even go to the max pain websites and figure it out anymore. Because as Moto says, it doesn't work. Okay? But we noticed at 209.50 and 210, there seemed to be a lot of call OI. Everybody got really bullish to SPY. And every time that thing tried to come up to 209.50, and let me show you the chart of the SPY, okay? Every time the SPY came up to 209.50, let me show you guys right here. Okay, every time at 209.50. I'll do it on the open range. Where's Friday? SPY. Okay, right here. So we're gonna do this. So what we were looking at on the SPY, okay, can you guys see this? What we were looking at on the SPY last Friday was two things. You had a previous high pivot at 209.27. You guys see that? So just, if it came up to 209.27, you could have said, I'm going to take it short with a stop above because I don't think it's going to break previous high. That's a technical pivot for many people. And then it came up again. They would not let this come up into 209.50. There was something about that 209.50 number that big money was scared about. And you could see it if you were watching the level 2. And I was sitting here watching the level 2 at 209 when it started getting up here. Big money was getting scared. Okay? So we took it short right around here somewhere. It was around here, right, Moto? Somewhere around here. Like around 2 o'clock. Somewhere right around here. Yeah, I said watch for a break at 209 and let's see. On the you want the option chain, Moto, or now NTC is one I never trade, guys. NTC is one I never trade, okay, for day trades. However, on a Friday, it's fair game. But does this make sense about this buy? So we identified that Friday at 209.50 level. I said I don't think they're going to take it out. Then I just had to find a reason technically that made sense. I'm not going to sit here and just jump in front of a freight train unless I can find a technical reason. And 209.50 happened to be previous day's high, which was a good pivot. And you once you started seeing one reversal candle, one down candle, then your next one, then it makes sense to go ahead and take that trade. Now he wants me to show Intel on the screen. Moto, do you want to come on and explain what you're seeing on Intel? On the mic. Let me see what I can see he's seeing. He wants it below 34, above 34 bucks. And then, yep. Then he's going to take it higher. Here's a good example of stuff I look for. Put Intel on your screen. I would like to see it drop under $34 before Friday. Okay, because look at all this put OI. 10,000 at 34, 10,000 at 33.50, right? So there's 17,000 puts at 33.50 and $34. Okay? So you got to have a bias. They're going to take it above 34. If they price the options right on the call side, you could play it to pull back up to the 34 strike, that keeping the 10,734 puts out of the money. There's no real call interest that comes in by bringing it back to 34. So what you want to watch for is a dip below the 34 and then play calls for them to bring it back to 34. Yeah, exactly right. So let's say if we come in on a Friday, let's pretend once again tonight is Thursday night. And this is what we're going to be scanning for tomorrow night. Okay? And we're going into tomorrow. Just as Moto had said, you'll be looking for a dip below 34. So you're going to look and say, okay, Intel just dropped to 33.50. It dropped to 30. You're going to say Intel dropped to 33.25. Okay? So let's do this right. Assume Intel drops to 33.25. Okay? On a Friday. And you see, and you've already identified, okay, all that put OI. That put OI should act as support, right? Do we agree on that? You understand that? It's heavy on the put side, right? It's heavier on the puts than it is on the calls, right? Right. So you until it drops to 33.25, you can say there's a lot of put OI that big money is going to want to keep. Your bias should be to the upside, assuming the market's not falling apart. If the market's falling apart, there's nothing these guys can do. Okay? If Fed raises interest rates, etc., etc. Right? Add up the puts. Add these up right here on your puts. Right now, big money is doing their job on Intel. They're keeping it above where all that put OI is. Okay? Do you see that? Now, if they drop it below here, and big money is going to do their job, they're going to bring it above $34. And I believe that's what you're trying to explain, Moto, right? Yeah. Okay, here's the deal, guys. I want to explain something to you. On a stock like Intel, okay? Assume for a minute that Intel is trading at, and I assume for a minute Intel is trading at 33.25 at 2 p.m. and you think this thing might rally, right? Well, let's just say it's trading at 33.55 and you think it may rally to $34. How much do you think a 33, actually, what's their strikes on that? Yeah, we can do it this way. What do you think a 33.50 call costs at 2 p.m. on a Friday? What do you think that costs? If Intel is trading at 33.55, and I'm kind of guessing, I would say maybe 12 cents? No. Like 12 to 15 cents, right? Something like that. It's going to cost you like 12 to 15 cents. Right? Yeah, I was going to say about 12. I think about 12. About 7 cents of premium in that. 5 cents intrinsic value, right? And 7 cent premium, right? Now, if smart money does its job and they move Intel to $34, what is that worth at a minimum? What is that option worth? You're buying the 35 call, 50 cents. So you're going from 12 cents to 50 cents. Boom. Right. That's with no premium included. So maybe, right. This is what we're looking for, guys. Okay? Now, this brings me to my second point. Notice how I gave the scenario that is trading at 33.55 at 2 p.m. You got to determine one thing. Are you going to trade in the money or are you going to trade out of the money? Okay? Here is something that you want to look for on your scans. When you're looking at the stocks, I like to look where they're trading near a strike. Now, on something like Intel, that cheap of a stock with these strikes, it's not going to matter so much. I would go in the money. That's just how I trade. Okay? With 50-cent strikes, I would just go right in the money and play it. Don't even look for it. No, right? No, exactly in the money window. No. Right. On this one right here, I would go 33.50. Period. I just one in the money. On a 33.55, it's not my flavor style of trading to go to the 34s. I don't want to be 45 cents out of the money. I just don't want to do it. Okay? Now, if it was trading at 33.45, I would be okay with 33.50. I would. 5 cents. You guys see that? Now, here's where it's going to get a little tricky. These stocks with the tight spreads that are really cheap. Yep. Going in the money is great. It's okay. If you're trading stocks like Tesla, Amazon, Google, You got to be very picky with your strikes. And let me explain this. Take Tesla for example. Okay, Tesla's strikes are so just say 2, 3. This is the spread I have on. I am going to tell everybody I will only be interested in trading Tesla when it is trading near a strike. Do you understand why? Yes or no? Okay. As an option moves in the money on a Friday, the market makers want to make money. How do they make money? They whack the spreads. So I'm just taking a guess. Let's say Tesla is trading at 229. Okay, what are you doing? What do you do? What do you do for Tesla if it's trading at 229? The 230 is $1 OTM. It may never get there. It may just totally waste, right? Okay? That may just be a wasted play. The 227 is $1.50 in the money. Okay, right? Let me ask you a question. On a Friday, if the market makers know that option is going to move, okay, they know this option is going to move, what do you think the bid ask, the spread is going to be on that $1.50 option? What do you think the spread's going to be on that? The bid ask. It's going to be wide as hell. Okay, that option is $1.50 in the money, may have a, and you may think I'm lying to you, the $60 wide spread. Not my game. I don't want to buy something with $1.50 of premium, real value, in a $60 wide spread. However, if I see Tesla come down to 227, say 25, or 227.75, and my bias is to the long side, do I have a trade? Yes or no? Do I have a trade? Damn right I do. Because why? But why do I have a trade? Intrinsic value is low. It's cheap. And not too wide spreads. Does that make sense, guys? It's important. This is very, 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 very important. I don't want to be paying, I don't want to have a spread that's 50% of my option. Yeah, there's no really intrinsic value. There's hardly, in the there's 25 cents. If I'm taking the 750s and it's trading at, I got 25 cents of intrinsic value here. If I take the 750s to the call side, I'm only 25 cents out of the money.
What do you do when you get to a festival site?
Widespread spreads get wider as it is in the money, and there's more value in the option because the market makers want to make money and they know it's going to move. And when it moves, it's going to move fast. So they're not going to let you get it. They don't want you to get it for free. They understand that a 50-cent move is going to drive that option price.
So at a festival like this, where you have
Does that make sense?
thousands of people,
When it's in the money, it's going to move fast. They understand that a slight 50 cent to $1 move in Tesla is going to drive that option price up, and they want their cut. They're not going to sit here and give you spreads like this. $1.77 bid, $1.80 ask. No way, Jose. They're going to give you like $1.90 bid, $2.35 ask. They're going to give you something like that. They're not going to give you this ever on a Friday in the money. Ever, 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 ever. They're going to do something like this. I don't want to play that. Because if it moves against me, not only have I lost on the spread, I've lost that it's moved against me so fast. This is one way you can control your risk. Picking the trades on the big stocks. And when I say these stocks, I'm talking ones that have a dollar plus wide strikes. Okay? If you got something like Intel with 50-cent wide, the strikes are 50 cents apart, it's not as big an issue as it is on something like Tesla. You can almost always find a trade on a stock like JP Morgan or Intel. On a stock like Tesla, Google, any of these ones with above $1 wide spreads, you got to be a sniper. You can't be a samurai just hitting everything. You got to be a sniper waiting for that trade to come to you. Does this make sense, everybody? Yes or no? It's because it's very important. You do not want to be doing Tesla lotto trades on something that's $1 in the money at the end of the day. It's stupid. Just go give your money to charity. It doesn't make sense, Rebecca. Okay. If Tesla, assume for a minute, Tesla, the strike you're choosing is $1. Okay. Assume for a minute, Tesla is trading at $290. It's trading at 229. Okay. What strike are you gonna pick? If you are bullish, what strike would you pick? You can pick the 227.50s, right? Or you can pick the 229s if you're bullish, right? Which one would you pick? If you're bullish Tesla and it's trading at 229, sorry, you could pick the 230s. Which strike would you pick? Okay. What do you think the 227 would be trading for? It's $1.50 in the money. You're probably going to have 75 cents a premium. So it's going to be trading at 225. Okay. Number one is pricey. Okay. What do you think the bid ask is going to be on that? You think it's going to be... You think it's going to be that? Yes or no? This might be, I don't know, 170, 165 by 250. I don't know. Could be that. Yeah. And it's going to move. And how do market makers make money? They make it on the spread. So not only is it going to be expensive, you're going to have this wide spread. So then you get in it, right? And it immediately goes against you. So instead of 160, 250, it's now $1, 160. I mean, you just got beaten up, right? You just totally got beaten up. However, if it's trading at 227.90, it's trading at 227.90. It's 40 cents in the money now, right? Does it make it a better deal, Rebecca? Now this 227.50 call, it looks more attractive. You know the answer is yes, but you don't understand why. So how much is now the 227.50? It's 227.90. It's 40 cents of real value. Right? Assuming the premium 70 cents. It's worth $1.10. The bid ask may be 90 by 120. As it goes up in price, they're going to expand the bid ask, and as they see it, the minute they see that start to move, they're going to expand that bid ask. I want to get them cheap. I want to get them as close to. No, the price of the option's gone down. The intrinsic value is now only worth 110. Before it was worth 160. As an intrinsic value, the value of the option goes down, they can't keep the spreads widening. Right. So the intrinsic value. Assume for a minute the intrinsic value is 40 cents. They're going to jack 70 cents a premium, and there's 70 cents a premium. Let's just say this is a fair price, plus 70 cents a premium. No, I'm sorry, you're confusing me. 40 cents real value, and let's just say there's 70 cents of premium that should be in that option. So it should be $1.10. The market makers are not going to let you get that at $1.10. They may put it at $1 bid, 90 cent bid, $1.40 ask. They're gonna make you try to pay $1.40 for that option when it's really only worth $1.10. Okay. Compared to if there's 90 cents of real value, plus 70 cents of premium equals $1.30. As it goes up, they're gonna increase the bid ask. You gotta watch it, Rebecca. I'll do a video tomorrow and I'll show it to you. Okay. Yeah, but on Fridays, the minute you start doing that, is the minute that moves, and you just lost it. But yeah, that's how I do it too. Though on Fridays I tend to go in the middle. On Fridays I change a little bit. Yeah, on Fridays I try to get in the mid price because I know they're not going to give it to me. And if it starts moving, you can lose that so fast. Well, no, it's just the option costs more, Rebecca. When an option costs more, many times you're going to have a wider spread. Let's look at this for a minute, and let me show you something. Let's look at Amazon right now. Okay? On the 615 Amazon put, what is the spread? $20, right? It's cheap. What is the spread on the 650 put? $90. The higher the price of your option, the bigger the spread you're going to find on a Friday. It's the same thing right here. On this 660, look, 660 call, there's an 18-cent spread. On the 625 call, there's a $130 spread. And you're going to see these go insane on Fridays. Okay? It's just how it is. And you once you get to do it, Rebecca, you're going to notice that. Okay? So we are looking for stocks on the big flyers that are trading near a strike. So when you're looking at your screen, and let's say you got 20 stocks, and if say Apple comes to 120, you have a decision right then and right there, because at 120 that Apple option, either put or call, is dirt cheap. It's as cheap as it's gonna get, unless it's still trading there an hour later. So you got a decision point to make. You got to look at your technicals. You got to look at where smart money's put it. Do you take it long? Do you take it short? Or do you take it at all? Is the market in breakout mode? Is it getting ready to run higher? And Apple's moving right up to 120? What are you going to do? You got it right where you want it. Right. Monster has horrible spreads anyway, Steven. But yeah, you're going to see... It's like when you see something gap down in the morning. That first 5 minutes, the spreads are incredibly hard. You know, when you play the opening range, sometimes it's not so hard to get the direction right. Okay? It's just hard to get in the trade. The spreads are so wide. The market makers don't want to give you something for free, right? They're not going to give you a free trade. If Facebook gaps down tomorrow, you're going to see the spreads on that thing explode. Why? They're not going to let you get in that on a tight 10-cent spread. Same with Friday. They know they're going to move. They want to make their money. Otherwise, they'd just be sitting here buying and selling them themselves. So they make it hard for you, and it's what you have to work with. So now tomorrow night we're going to go over candidates, and on Friday I'm going to show you how I trade them. If you were in the room, Charles was in the room, right? We sat here and I said, JP Morgan. I rationalized it like this. We looked at JP Morgan on Friday. Let me show you the thought process. Once you understand the thought process, then you're going to get it. JP Morgan, I remember this trade I was looking at. This guy Wednesday. Okay, this was JP Morgan on Friday, right? Last Friday. Yeah, right here. Check this out. Hey, okay, I'll go over this one here real quick, and then Moto's gonna come on the mic. I'll get Moto on the mic. And let me do this. Let me just go over one example. So here you had JP Morgan on last Friday, right? And there's a 64.50 strike. I believe it come down here at the 64.45 area. Okay? It came down to the 64.45 area. See this right here? Yes or no? And you got this candle, and the market was starting to turn up, and I said, you know, this 64.50 JP Morgan call is only 5 cents. It was only 5 cents right here. And the market was turning up, and I said, if this can make a run above 64.50 with some put OI, is going to double. And it doubled. Now on the way down, you could have said, okay, 64.50. Wow, this just broke low of day. This just broke the low of day, right? It broke the low of day here. I'm going to try the 64.50 put. You probably could have got it for like 5 cents. And it drops to 64.12. That's a nice win. How we played Facebook, I'll tell you exactly how we played Facebook. So last Friday, okay, so to begin with on Facebook, number one, I cheated. I grabbed the 105 puts when it was trading up here because it depends, window 5, 10, depends on what it is. I usually like to play around $400. You can play 2, you can play 1. Usually like on something like Tesla where it can really get tricky and move, I try not to take as much risk. So Friday, I took the 105s. I didn't call it out in the room. It was a counter trend trade. I just felt the 105, big money, wanted to drop it. Boom, we nailed it. Charles, you caught that, right? You caught it right at the open, wrote it down. I think it was like a triple. Then we look, right? What happened right here? Guys, what happened right here? What happened right here? Talk to me. What happened right here? It came down at 102. It put in a potential reversal candle. It looked like it was going to bounce, right? Can you agree that looks like a bounce? Okay, here's that trade. $102 call at that point was 50 cents. Right? What did it do? What did it go to? So at this point in time, when Facebook dropped to 102, held 102, looked like it was going to put in a bounce. This move right here was 50 cents to $1.30. Okay, so let's analyze the trade for a minute. Facebook sells off. You missed the sell-off, but it comes down. The low of that was, the low was 102.01. It holds 102. You got to trade. Does it meet the criteria? I don't know, Mark. I would have to look. I think there was put OI. Yeah, I do. I believe there was. Held 102. It looked like the ES was bouncing. This 102 call was 50 cents. Doesn't meet the criteria that we have for a trade. What is the criteria? We want it near a strike to get it cheap, right? It's right at a strike. You don't get any better than that. Do we have a technical indicator that's showing that it could reverse? Well, you got somewhat of a hammer candle, and I believe the market was turning a little bit at that point. And assume you had put OI at 102. Assume you did. That's another criteria, right? So you could have entered this at 50 cents. You could have got out at 25 or 30 if it went against you. And you could have wrote it up. 50 to 130. What is that percentage-wise? I don't know. It's pretty good, right? how many days of the week do you get to trade an in the money Amazon put for $100? Okay, here's our other one. Here's the other killer we had. This is the one I really want to. I stress this one, but a lot. Charles, did you take the Netflix? So Netflix was being stubborn. If you were bearish Netflix, okay, it was being really, really, really stubborn. Okay? And I got this all marked up. It was being really stubborn. But something happened here. Look what happened here on Netflix at 110. What happened? I mean, what happened on Netflix around 2 o'clock? What happened on Netflix? Number one, retail was buying those 110 calls early in the week. There was high call OI at 110. So we identified when you have high call open interest, what does smart money want to do? They do not want those to go in the money. Trust me, they did not want those 110 calls in the money one damn bit. Not for 1 second did they want those 110 calls in the money. What did it do? It came up to 110 and wicked right there. Put in that candle right there. What did that stock do? What did that option do? I said, guys, 110. Your risk is to the downside. You could have got, I think I said, Charles, you took it, right? I'm sure you did. I said, you can get this for about 60 cents right now. You can get that 110 put. All they got to do is bring Netflix down into the close. It went to 210 from about 60, 42 up to $2.20. Someone got out. Just on this move off 110. So guys, what was the criteria that we talk about? Someone list the first one. Someone list one criteria. Let's list the criteria for that trade. Did we have a technical reason to do it? Yes or no? Was there a technical reason there? And on Fridays, sometimes you gotta let your technical reasoning not be so strict as you do the other normal days. Was there a technical reason? Yeah. It came up, it tried to take it out, it couldn't take it out. This candle sold off below those last two candles. Okay? Whatever. It's just, this is a reversal pattern that has a chance to reverse it. There's a technical reason. Was there a reason on the open interest? Oh yeah. 110? Yeah. Oh yeah. Gary, because these guys, there was a lot of open interest at 110. Anybody that sold the 110 calls, if this goes to 110.50, they lost. If you're big money and you sold 1,000 contracts of 110 naked on Netflix, do you want that going against you? Or assume you didn't do it naked. Assume you did a buy right. So you got all the shares. Now it's going against you. You're sitting here dumping. Because you want to keep the premium. You want to keep the shares. But if you sold the 110 calls naked, would you really want that to go against you? Not me. All that high call OI at 110 acted as a wall of resistance. And I'll bet you anything on stock twits, when this was coming up to 110, there were people saying, oh my God, Netflix is going to the moon. I got to buy these 110 calls. And right when they were buying those 110 calls is right when smart money started dumping. See, the bullish sentiment this fall. And I looked at the open interest on Netflix. Looked at the open interest on Netflix at that 110 level. And I said to the room, guys, I am hoping the Bulls can take Netflix to 110. But you have to be a sniper. A sniper waits for the trade. Netflix at 110 on a Friday with 2 hours left to go in the trading is a gift. With all that high OI. It's a low risk trade. Maybe, Danny. Who knows? But I can tell you, going in on the Friday, I want to really see Netflix. I would love to see a bunch of 120 OI develop on Netflix. Have them run Netflix right up to that 120 OI. And you know what I'm going to do? Do another trade like that. Big money defends their positions when they have the ability to. Big money will constantly defend their positions. Now, there's going to be situations in the market where they can't defend it and they lose control. Then they're going to go into futures and they're going to play games in there. Okay? Now, Moto says he has another idea. Moto, can you go over your idea? Let me put this on pause. Okay, so I'm gonna end the official recording. We'll just do some examples.